Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Jim Brown, and Jim is a partner and business valuation specialist with Parasho, Tombor, and Brown. And he's been with the firm since May 1997. Before that, he was a regional vice president at Union Bank and Bank of the West. Jim holds an MBA from the University of California, Berkeley, and a BA in Business Administration with an emphasis in finance from San Francisco State University. He's an accredited senior appraiser in business valuation, which is awarded by the American Society of Appraisers, or ASA, and he is a certified financial planner, or CFP. And with a little registered marker around it. Certified financial planners are very clannish. Anyway, he performs valuation studies for a number of purposes that we'll discuss in our interview, and he also provides management and financial consulting services. Jim, thanks for joining me today.
Thank you.
Okay. Today, Jim and I are going to be talking about the role of the business valuation specialist. And this is just an introduction to sort of a complex area. He gives hour and more presentations, and sometimes we'll get into minutiae about how this all works. But anyway, this is we'll say, a more recent breed of financial professional that have been around to some degree, but it's become more formalized in more recent years, past 20 years or so. And so I wanted to get some information to our viewers about this and to know that these people are here to help. Okay, so Jim, as a certified public accountant, that's what I do, the CPA, in tax practice, I've seen the business valuation area like blossom out. You know, I've been in this business for 40 years, so oh well. Anyway, the use of a qualified appraiser is required in the tax law by the courts and even for financial reporting. So what the heck is a qualified appraiser? And maybe you can comment on the requirements.
Sure. Well, a qualified appraiser is someone who's studied the principles of finance and valuation, someone who's been tested on it, and someone usually whose work has been peer reviewed, and someone who's required by their accrediting organization to be totally independent. And that means that if there's two parties to an appraisal that are adverse, one wins and the other one gets more or less, then the appraiser doesn't take a side. The appraiser is an advocate for their opinion, not for either side to a transaction.
So if an appraiser is hired by a buyer or hired by a seller, or maybe that's not such a great example because I don't know how much you're involved in those transactions, but if you're hired by a beneficiary or you're hired by the other beneficiary and they may have two different interests, you should still have the same answer.
We do. Our answer is the same no matter who our client is or who the other parties who are interested in the outcome of the appraisal. Another attribute of a qualified appraiser is someone who has experience. In American Society of Appraisers, we've got actually 5 different disciplines. You're talking about business appraisal primarily here today.
Right.
But most people's contact with an appraiser is someone who has appraised a home or a condominium.
Right, like if they're going to have a mortgage refinancing, they have to have an appraisal done.
Real estate transaction.
Right.
But there are specialists with the same rigorous requirements, at least in the ASA, that are specialists in personal property, including things like fine art and furniture and fixtures and that kind of thing.
Yeah.
And then gem and jewelry specialists, machinery and equipment, and of course real estate. Then the business people are intangible asset appraisers. All those people in the ASA to have an accredited senior appraiser designation must have at least 10,000 hours of full-time experience. That's 5 years of experience. And that's important because after you've studied the theory and begun applying it, you find out there's things that you really don't know, and you have to go back and relearn those things. So experience is an important part of it. So all those go in to the definition of a qualified appraiser, and different appraisal organizations have different levels of rigor involved in their accrediting process.
Okay. And so what it boils down to is that there may be formulas and other things that you may use, but there's also some judgment that's involved in coming to your opinion.
And it's understanding if there's formulas that are applied, what they mean, whether it's appropriate to apply them to a case or not, and be able to interpret the results. So it's more than mathematics that's involved in it.
Okay. So what are some of the areas for which valuation studies are used?
Sure. Well, the most common is for estate and gift planning. As an example, someone dies, I'm going to make this up, and they owe 30% of the stock in the San Jose brick factory. I don't think there is a San Jose brick factory.
Not that I know of.
But that's the hypothetical case. So for the estate, the family and all the other beneficiaries of the estate, and also the government, are interested in the value of that 30% of stock, because it may or may not be subject to estate taxes, or they might want to give away stock before they die as another estate planning strategy.
Yes.
And so the value of that needs to be independently estimated, and that's the kind of thing. So then in addition to that, there are shareholder disputes where there might be two, and often it's more shareholders or partners, whatever the entity type, owners of a company, and one either wants to leave or the others want someone to leave, and so they might say, well, if you want me to leave, then buy me out. Well, I'll offer you $50,000. Well, what do you mean 50? It's probably worth 500,000. So they get into this debate. They need a third party to go in who doesn't have a stake in the outcome, that both of them trust to estimate the value so they can make a deal. And we do that outside and inside the courtroom. There's a court process for that. I'm involved in one of those right now, where the court approves a panel of 3 appraisers, and those 3 appraisers work either independently or together, come to a conclusion, and the court rules based on that conclusion. And the third reason for appraisals would be divorce, where there's a family business that's owned, or it could be a professional practice, and that value needs to be split between the parties to the marriage. So again, it needs an independent third party. And then the part that's grown the most in the last few years is for financial statement reporting purposes.
Right.
Accountants get involved in that.
Yes.
And accounting years ago used to always report transactions or assets or liabilities at their original cost. And some of those are depreciated over time. Well, the accountants decided that maybe that's not as relevant to the value of that property today, so they're trading what they say is relevance for accuracy, or trading accuracy for relevance. So they're estimating the value of a variety of assets, including intangibles, and putting those on the balance sheet.
Right.
And there's just recently a consortium put together of 3 appraisal organizations: the American Society of Appraisers, the American Society of Certified Public Accountants, AICPA, American Institute, and another group called the Royal Institution of Chartered Surveyors, and it's called RICS. Those 3 formed a consortium to create a special designation in valuing intangible assets for financial reporting purposes.
Wow.
And it's new, and it took several years to reach an agreement on what the requirements were for it. One of the things that prompted it is the government regulators that oversee particularly public companies were afraid that the valuation work for intangible assets and financial reporting was not good enough. So they asked our groups to get together to create an exam and an experience requirement so that people are more qualified to do that work. So that's a new aspect of valuation. And then of course there's merger and acquisition transactions. So sometimes people want to know, well, I'm considering offering my company for sale, can you help me value it? Or they've been approached more often by another larger company, and I'd be interested in buying your company. But they have no idea what it's worth. So we consult with them to estimate its value. One of the key things there is that I always tell clients when we do work for an M&A transaction, we'll help you estimate a base value, but don't ever show my valuation report to a buyer. Because if you do, that's all you'll ever get. And there may be a group of buyers who will pay way more than the company is really worth to a single owner or to the current owner. They have special reasons, so you need to let the market help determine what the value is and not tell. But it gives them a floor understanding, so there's probably a number below which they'll decide to keep the company and not sell it. So there's quite a variety of reasons that people do appraisals.
Yeah. Okay. So a couple of others that I know you talked about estate planning, but actually we have to have reports for when we file gift tax returns and estate tax returns, and so your reports are very important in those contexts, and that's where a lot of the history started early on, but then it's, like I said, it's sort of blossomed out since then because they found out that the appraisal service is so useful, valuation. And again, in financial reporting, what happened that people were carrying the value of assets that were acquired, again, like you said, at the historical cost. And the concern is in many cases, some of these things that may have been very valuable at one time had lost some of their value, and so they should be looked at from time to time.
Well, and some of them are worth more. If you, in the example, you might have bought a building in San Francisco in 1960 for $1 million. It might be worth $20 million today.
Yeah. Well, the last that I checked, they're not allowing the write-ups, but I'm not a financial accountant, so I can't really comment that much related to that, except for I think in the classes that I've taken in the last few years, they were still doing write-downs. I hadn't heard of write-ups yet. But maybe we'll get there if we haven't already. All right, maybe you can talk a little bit about the process. What is involved when you do one of these business valuation studies?
Sure. There are 3 different approaches we call to valuing a business. This is the business valuation. One is called an asset approach, a second one is called a market approach, and third one is an income approach. And we consider all 3 methods. So the value of a business is primarily determined by its ability to produce profits. And when people hear about real estate, that it's location, 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 with businesses, its value is based on its profits, profits, and profits. The more it makes, the more it's worth. And seldom, although it happens, seldom is a business valued based on the value of all of its assets, like its cash, receivables, inventory, and equipment. So in the market approach, we would look at a private database of sale transactions of companies that are similar to this one. They're either in the same business or in a similar line of business. And we see that, well, these companies sold for this much money, and we can compare the value to information in the financial statements of the company that was sold, like its profits. And the famous PE, price earnings ratio, is one of those. So we would take them, what that does is normalizes these so we can get some kind of a common denominator indicator. So if we had 10 transactions, we divide each of those sale prices by their respective earnings, and we get a spread of different price earnings ratios. And sometimes they're in kind of a reasonably narrow band. So we would say, well, if those companies sold at that kind of a price earnings ratio, maybe this company might sell for something similar. So we can take either one or several or some kind of a central tendency of those ratios and apply them to our subject company, and we get a value from that. Now, another way we do that same process, though, but from publicly traded companies. Because publicly traded companies, we call that a guideline public company approach. Public company financial information is very good. The values are very current and they're very accurate values. The issue is that they're typically huge companies, and we're valuing a company whose annual sales are 10 million, not 10 billion.
Right.
And public companies are typically geographically diversified, whereas our subject company commonly operates in one area, say only in Silicon Valley, not even around other parts of the state. So we account for those differences and apply those multiples, like price earnings, and there are others, to our subject company. Now we have two values. Then we look at its earnings, and the way we apply the earnings is a simple example. If a company makes $100,000 a year that you can take home as a return on your investment, and let's say you wanted to earn a 10% rate of return on your investment, you would pay $1 million to buy that company. Now, how did I figure that out? I took the 100,000 of earnings, divided it by the decimal equivalent of my rate of return, which is 0.10. And if you take out a calculator and try that, the result will be $1 million. How do I know that's correct? Because if I paid $1 million and it earned $100,000 a year for me, that 100,000 is 10% of my investment amount. I got what I bargained for. So we use that kind of a process, knowing what kind of rates of return that investors might want, and then apply that to the earnings of the company. The key, though, is which earnings. Last year, the last 5 years, the average, or are the earnings in the future going to be different? So we consider all of those things and looking at what the historical earnings have been and what the expected future earnings are expected to be. In fact, the future earnings estimate is way more important than the historical. Because if I bought the company, I get the earnings that are coming after the acquisition, not the ones that have already been earned.
Right.
So we spend a lot of time working on that and estimating future earnings and answering questions, why should I believe that? So now I've got 3 valuation methods, 3 numbers. They're usually not the same. And now the appraiser has to use his or her judgment to decide about the quality and the quantity of information from those sources, and then reconcile it and weight the final number to a final conclusion. So there's much more to it than that, but that's kind of a summary of what we go through.
So I'm sorry, so was one of the ones, and maybe I just missed it, so was one where you're actually valuing the assets again and the liabilities? In other words, you're sort of looking up what are the building blocks of this financial statement to get a difference? Or?
Usually we're valuing the equity directly.
Okay.
We can value the assets, and we do that. That requires just a different application of the same procedures.
I was just thinking that there may be some operations, for example, if they're real estate heavy, basically renting a building that may be in an LLC or something like that, or that in that particular case you may be waiting pretty much, okay, well, what's under this thing?
Well, in that case, I'm glad you brought that up, because that's another very common purpose for a business appraisal, a business that owns real estate. Let's take an example of a company. It can be a partnership, a limited liability company, it can be a corporation.
Yeah.
And it owns a 25 unit or a 50 unit apartment building.
Yes.
And that's its sole assets. So what would someone pay for a 10% ownership in that company? So we do the same kind of thing. What goes through the investor's head is, well, will it pay me dividends from the earnings while we own it? And will you ever sell the property, and will it be at a capital gain at some point in the future? So we analyze the earnings, the historical earnings, and again look to a projection of the future expected earnings, And that could be the same or different, like what if they need to replace the elevator, put on a new roof, repave the parking lot, all those kind of things.
Right.
Or is it subject to rent control, which is another issue.
Right.
And so we have an estimate of the future earnings over some period of time. Then we ask the owner to go get the real estate appraised. Real estate is the single asset that requires a license, a state license to appraise real estate. We are not real estate appraisers. So we hire a real estate appraiser to value the building. That gives us the value of the building today. And we estimate over some period of time, would it grow in value, and it might be sold, and we would probability weight maybe 2 or 3 different possible outcomes and estimate the value of that investment today. So we do consider the assets. A case where we would consider only the assets would be a company that has very low earnings. And when you capitalize, use a multiple or divide by a rate of return, capitalize its earnings, you get a value that's less than you would get if you just sold all the assets, paid the liabilities, and went out of business. Its liquidation value is sometimes higher than its value as a going concern.
Okay. Why would someone need a business valuation specialist that doesn't actually have a business?
Well, one would be where someone inherited an ownership interest in that entity that owns real estate. It's not an operating business, but it's still a business. It's a holding company. Sometimes people inherit a promissory note where grandma loaned $600,000 to her neighbor. And the question is, that's an asset in her estate, so it's not really a business, but we need to appraise its value. Patents, same thing. I valued a company about 3 years ago that had a portfolio of about 60 patents, and that's all it had. So we needed to estimate the value of each and every one of those patents and understand everything we could about it to estimate its value. It was a hope. We've got a great product. Maybe somebody would like to pay us to be able to use our technology, but they hadn't yet. It was a maybe. So those are just a couple of examples where it's not really a business, but it's an intangible asset that needs to be appraised.
Okay. So can you compare the valuation approach used by a business broker with the approach that you use?
Sure. A business broker's job, if they're representing a seller, is to get the highest value they possibly can for their client. It may not be the most reasonable value, but as a seller, you don't care. You want the highest value. So the difference is that an appraiser always must be independent. So an appraiser's fee cannot be a function of the sale price of the business, whereas a broker's fee is dependent on that. So we uncouple that relationship. So that the difference is that the appraiser considers the most reasonable values that would be paid, but there could be a synergistic, so-called synergistic buyer that will pay much, much more money than based on reasonable rates of return. And sometimes we know why they would do that, and other times we don't. So what a broker would do is attempt to advertise the company for sale in the market and hopefully get an auction environment where you've got several bidders on it. And they might buy it for way more than based on rational rates of return, someone else might buy it. So our world, unless we can identify that there are these synergistic buyers, it's usually rational rates of return, and our fee is independent of the value of the business.
Right, okay. What's the role of risk in a valuation study?
Well, risk relates to value of a business is a function of earnings. And so the question is the earnings volatile? Meaning, is the earnings steady every year within a narrow band, or is it up one year and we lose money another year? So the risk that I will or will not earn the income that I'm expecting is considered in the valuation. The higher the risk, the lower the value.
Okay. So we just have a short time left. Jim, would you like to maybe throw out a final thought related to the role for the business valuation specialist?
Sure. It's important to understand who the accrediting organization is that gave the credentials to the appraiser, to ask questions about it, to make sure that their work is peer-reviewed, that they have rigorous exams and an experience requirement and an ethics requirement as well. That's probably the most important thing to look into, and ask them what was involved in getting your credential and how does that compare to others. Accountants don't have to worry about that because there's only one accrediting organization.
Well, yeah, but I mean, for example, people do have a choice. They can get an enrolled agent.
Yes.
If they're going for a tax preparation, they can go to a CPA. They can go to an attorney in some case. And there are some people that aren't enrolled, that they put out a shingle. So anyway, so there is a variety that is out there. And then there's also a range even for the CPAs, but at least we do have some consistency, again, for CPAs. I think it was sort of the model even for the appraisers, that we have our own exam, we have our own experience requirements, we do have ethical standards, and so forth that we do have in our profession as well. James, I want to thank you so much for joining me today, and it's been a real pleasure having you here with me.
Thank you. Appreciate it.
Folks, so Jim doesn't know what I'm going to tell you right now, but this is actually the last of the series of Financial Insider Weekly. And so for you folks that have been regular viewers, I want to thank you. I want everyone to know that we still have our website is financialinsiderweekly.com, and you can find past episodes there. And many of the stations that have been showing Financial Insider Weekly will be continuing to show some of our past episodes. And so I hope you'll catch some of those. But again, look through those past episodes and look at the various topics that we've had. And I hope that you'll agree with me that I've brought wonderful people like Jim here, that some of the best financial professionals in our community to share with you and to get the value from their experience. So with that, thank you very much, and I hope you'll continue to look at some of those back episodes of Financial Insider Weekly.